All right, so good morning, everyone. So welcome to today's webinar brought to you by Bursa Malaysia and managed by LifeChamp. So my name is Carmen, and I will be your moderator for today. Right, so the session title for today is Trade the Market with Elliott Wave Theory. But before that, we do have a special guest joining us here today from CIDRAC to share with you a little bit more what CIDRAC is about. So with that being said, please welcome Ms. Mingy to the floor.
Hello, everyone. Thank you, Carmen.
All right, so let me just stop sharing and I'll pass the floor to you.
Okay, let me share my screen first. Okay, so good morning, everyone. My name is Mengi. I'm a case manager in CIDRAC. So the disclaimer here that this presentation is for the purpose of information to participants of this webinar. Okay, who is CIDRAC? In short, we are an independent and impartial body set up by the Securities Commission that helps resolve capital market disputes without going to court. Why do we exist? We were set up as an investor protection infrastructure in the capital market. So many investors think that when they are having dispute or monetary claims with their investment bank or broker, all they can do is to file a claim in court. Actually, we are an alternative dispute resolution center. So how do we help? I will go into that in a minute. So what are the fees? Our services are free of charge to investors with claims up to 250,000. So how do CIDRAC benefit investors? CIDRAC helps by contributing towards enhancement of investor protection. By resolving capital market-related disputes, investors can come to us without having to fork out any money to look for lawyers to go to court. And who is eligible to file a claim? Before filing a claim with CIDRAC, there are a few requirements. Claimant has to be an individual investor or a sole proprietor. The claim must be against the CIDRAC's member. Who are our members? Our members are stockbroking firms, investment institutions licensed by the SC, etc. You can also find a list of our members on our website. The claim must involve a capital market product or services. It must be related to monetary loss. Also, before the claimant can come to CIDRAC, they must already have lodged a complaint with the member. After which, if the claimant is still not satisfied with the member's reply or does not receive any reply for 90 days, CIDRAC can then become involved in the claim. So how can CIDRAC help you? The dispute must be between an individual investors or sole proprietors and capital market intermediaries who are CIDRAC's members. And one more element is the claim must involve capital market product or services, such as securities, derivatives, PRS, fund management, and unit trust. How to lodge a complaint? First, you may download our CIDRAC's claim form from our website, fill up the form, and together with your supporting documents, send to our email address, which is info@cidrac.com.my. It's on our website as well. If it is an eligible dispute, a case manager will be assigned to your claim, and the case manager will contact you to proceed further. Dispute resolution process. So we have talked about the requirements in order to bring a claim to CIDRAC. Next up, the dispute resolution process. As mentioned, before bringing a claim to CIDRAC, the investor must have already filed a complaint with the member. The member then has 90 days to resolve a complaint through their internal investigation system. If the investor is still not satisfied, the investor has 180 days from the date of the member's final reply to file the dispute with CIDRAC. After filing of the dispute with CIDRAC, CIDRAC will assess the eligibility of the claim. During this stage, we call it case management. Case manager will send inquiries to both parties to try to understand the concerns and help parties to resolve dispute at an early stage. If the dispute is still not resolved at this stage, the case will proceed to mediation, where a date will be fixed for both parties to come before a certified mediator. During mediation, mediator helps with facilitating communication and encourage open and constructive discussion. If the mediation is successful, a settlement agreement will be entered into and the dispute is resolved. If the mediation is not successful, the case will proceed to adjudication, where an adjudicator will come up with a decision after hearing from both parties. So these are our contact details. I have come to the end of my introduction of CDREC, so thank you everyone.
All right, so thank you so much, Mia, for your sharing. Just put by my side. All right, so once again, back to the main topic again. Title is Trade the Market with Elliott Wave Theory. So of course, allow me to do a short disclaimer. So whatever that is shared in this session is mainly for educational purpose. So by no means that we are providing you any advice to buy or sell any forms of securities. So you are 100% liable for any investment decision you make. Right. So today, we are very honored to invite the CEO of Sigma Wealth, Ms. Pauline Yong, to share with everyone here how she trades the market using Elliott Wave. So a little bit of a background, Pauline Yong is a licensed financial planner certified by the Malaysian Security Commission Financial Planner Representative License and Bank Negara Financial Advisor Representative License. And she is also a course trainer and public speaker at Financial Planning Association Malaysia, Symphony, and Bursa Malaysia. Over 25 years in education, she has accumulated over 50,000 students and conducted over 200 large-scale corporate courses. Pauline is also a best-selling author who has published 6 books on investment and financial planning. Her articles has appeared in financial magazines such as the Personal Money, Money Compass, and many more. So with that being said, please welcome Ms. Pauline to the floor.
Okay, thank you. Thank you, Carmen. Hello, good morning, everyone. Welcome to the Bursa webinar. And let me share my screen first. Okay. Okay, so you can see my screen, right? All right. Okay, now today's topic is trade the market with Elliott Wave Theory. So before I continue, I would like to ask in the audience, how many of you who has been trading with the Elliott Wave Theory? Okay, you have been using Elliott Wave in either a little bit or extensively that you know about Elliott Wave. Okay, so how many of you? You may type in the chat, okay? So if let's say you do not have any technical analysis background, you can put a 0. If you do not have any technical analysis background, you can put a 0. And then for those of you who have the Elliott Wave background, maybe you can put a 1, okay? Put a 1 if you have the technical analysis background. Wow. Okay, so I can see many doesn't have any TA background, except one person has a Elliott Wave background. Okay, interesting. Okay, so I will use a very layman term to explain this theory. This theory, in fact, is psychology. It reflects on the psychology of the market participant. Okay, it's not so difficult, but sometimes it's the counting of the wave that make people feel that, oh wow, so many rules. Okay, but however, if you understand the basic thing about how the economy or the stock market works, right? Elliott Wave can give you this idea. Okay, I'm going to teach you some simple way of recognizing. Okay, so it won't be if you want to use a simple way, it's like a rule of thumb. Okay, so it won't be too perfect, but then it's just a rule of thumb. So that will help the beginners. Okay, let me go through. So this is today's we're going to learn how to count the Elliott wave. Okay, so and then how we can apply onto the stock market, the stock chart, and we'll look at the case studies of the different types of charts, and then what are the chart that can count easily and what are the chart that cannot count easily. Okay, because there are so many charts out there. Not all the charts you can count easily. It's not so obvious. Some of the charts is not so obvious. So I will show you what are the charts are quite obvious and then what are the charts are not so obvious. And at the end of it, we will also look at the Bursa Academy, the simulator, and then we see how the ETS as a tool to practice trading. Okay, so we will be like a simulation whereby you will learn how to invest in the stock market using a paper trade or virtual trade. Okay, so let's start. The origin is a long time ago. Okay, so that was long time ago where if you can see this person name is called Ralph Nelson Elliott. So this name Elliott Wave is named after him. Okay, so he's the inventor. So see, he's the father of the wave theory, which is commonly called and more accurately described as the Elliott wave principle. Born on July 28, 1871. Wow. So this 1871, okay, but that doesn't mean that it is outdated. So this pretty much a lot of the traders out there, they are very much into the wave theory, which is Elliott wave theory. Okay, so and he has actually examined the way that the stock market move. Now here you have to bear in mind that these days, right, in the early 19th century, and this 1871 to 19 something. So 19th century, 20th century, this kind of a time whereby we do not have internet. Okay, the internet doesn't come to us until middle of 1990s. Okay, so that means before 1990s, right, you do not have computer, you do not have internet. You do have computer, but then you do not have this kind of a convenience of the chart. So that time, all the charts were all recorded by pencil or a pen on a piece of paper. So they have to record all those waves and then on a piece of paper. So when Elliott Ralph Nelson, he was doing research on this price, he actually was using his own traditional way, manual way of keeping track of the price theory, and yet he's able to see the pattern. Okay, and he see that the pattern is like occurring over and over again. And then he see that this one, it looks like the wave, because he went to the seaside and then he saw the wave come by, and then the wave retreated, and then the wave come by again and then retreated, and then the wave come by like in a cycle way. So it's like repeating, the waves are repeating in the seashore. So then he named this kind of a price pattern named after his observation, okay, that the price keep on repeating. Okay, so this is the wave, and you can see that the wave pattern, it is classified as 1, 2, 3, 4, 5 ABC. Okay, so 1, 2, 3, 4, 5 ABC. So we count these 5 waves here as the up wave. So this is the bullish wave, okay, bullish up wave. And then the ABC is the corrective wave. So you have the impulsive waves and the corrective wave. So if you are looking at a normal chart, like going higher and higher and higher, so then this is a bull trend, right? So this is called the impulsive wave, which is the main trend. Okay, and then after that, then it may go for a correction. And then this kind of a correction is called the corrective wave. Okay, so then you have the 5 impulsive wave and then 3 corrective wave, and then it will happen over and over again, and then it will 1, 2, 3, 4, 5 ABC, 1, 2, 3, 4, 5 ABC. So it will be like going higher and higher, but then at the same time it's repeating about this 5 waves and ABC, repeating over and over again. Okay, and then it can be going on the uptrend. It can also be counting on the way down, on the downtrend as well. So when it is on a downtrend, it will be like this: 1, 2, 3, 4, 5 ABC. Okay, so it'll be 1, 2, 3, 4, 5 ABC. ABC is going up because it's the opposite wave of the downtrend. And then you go down again. 1, 2, 3, 4, 5, and then ABC. and then you go down again. So that means you are actually going down, down, down. And then inside this down, you are counting like 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5, A, B, C. So within the waves, you have the wave. So it's called wave within the waves. Okay. Okay. So far, so good. Okay. Can I see a show of hand? So far, are you following? Okay. If you are following, you put a yes. Okay. If not following, you put a no. Okay. Yeah, if you are following, you put a yes. Okay. So now I'm going to show you some of the application. Okay. After this, I will show you the real chart. Okay. So sometimes you won't see anything until you see a real chart. So, but however, before we see the real chart, we need to learn about the theory first. Okay. Okay. Hello, Sing Hop. Okay. Hi. Okay. So here, so while applying the Elliott wave to any chart, we must keep in mind an important point. So the Elliott wave principle does not provide certainty about any one market outcome. So there is no 100%. So whether you are Elliott wave or you are Fibonacci or you are whatever, there's no 100%. So all of us, we have to acknowledge that in the investment world, nothing is 100%. Okay, you will never see somebody say that, oh, I'm sure the market is going to crash. I wouldn't want to make this kind of a statement. Nobody can be sure of anything because the market is so dynamic. Okay, it is made up of so many participants, and then it is out of so many market forces. No, I haven't shown any chart yet. Okay, so before I show any chart, I want to talk about the theory first. Okay, so you didn't miss anything, rest assured. Okay, so instead, it gives you an objective means of determining the probability, okay, probability of a future direction of the market. So everything about investment is about the statistics, it's about the probability, it's about the risk, okay? So and anything to do with probability is about risk. So here are some rules, okay? Rule are for you to memorize, okay? You have to memorize. But these are simple rules, not so difficult. So wave number 2 should not break below the beginning of wave number 1. So wave number 1 is 1, 2, 3, 4, 5. Okay. So 1, 2, 3, 4, 5. Okay, so we have this 1, 2, 3, 4, 5. So now it says here, wave number 2 should not break below the beginning of wave number 1. So therefore, when you are doing a 2, and this 2 cannot go all the way down there. You cannot say 1 and then 2, lower low, cut already. So wrong. Okay, so that means that when your 2 is overshot your wave number 1, that means the uptrend is finished. Okay, so you are in a downtrend, so it will be counting downtrend. So this one become the wave number 1 of the downtrend. Okay, so it will be different already. Okay, so that is rule number 1. So the correction cannot be below the beginning of that wave. Okay, so if the correction is like you're having a lower low, then that's a different trend already. It's not an uptrend anymore, it's a downtrend. Wave 3 should not be the shortest wave among wave 1, 3, and 5. Okay, so meaning that your wave number 3 shouldn't be the shortest. Okay, so usually the wave number 3 is the longest, but occasionally we do see number 5 is the longest. Okay, so but in any case, the 3 cannot be the shortest. Now, wave 4 should not overlap with the wave 1. Okay. Now, when you see this is the correction, it's actually, if you look at the even numbers, right? The even numbers are the correction. The odd numbers are the uptrend. Okay, you have the uptrend, and then you have the corrective wave. So this 2 and 4 is the correction. So wave number 4 should not overlap with the wave number 1. So when you are counting the wave 4, right, you have to make sure where's my wave 1. This is my wave 1. So I cannot intersect with the wave 1. So I cannot go all the way down to here. I cannot cross below. However, there is exception. Okay, so the exception is for futures and commodities and forex. Okay, commodities. So except for futures, commodities, forex, all this, the fluctuation movement is too fast, too volatile, and sometimes we do allow. Okay, but nevertheless, usually for an index or a stock, blue chip or whatever, usually we do not want to see this wave 4 cross below the wave 1. Okay. Then the last one is the rule of alternation. The wave 2 and wave 4, so these two corrective waves should unfold in two different waveforms. So meaning that there is this corrective, right? Correction, right? So this correction pattern will be different. Okay. So now I want to share with you the chart now. Okay. Wave 4 can overlap for diagonal triangle. Okay, so wave 4, no matter what, okay, no matter whether you are what triangle or what chart pattern, as long as you are looking at a normal chart, you should not overlap. However, if let's say you are like a commodities, futures, forex and all this, maybe we allow. Okay, but nevertheless, most of the time I wouldn't want to overlap. When you want to count, right, try not to overlap. Okay, because there are different ways of count, like a subjective. It is quite subjective in counting the wave. So person A may count the wave differently from the person B. Okay, they may count it differently, but doesn't mean that they are wrong. They are correct. It's just that they have a different ways. And sometimes when you want to trade, you have to find those wave patterns that are very, very obvious to you. You will trade, then you can trade this Elliott wave. So if you happen to see a chart whereby you can't even see those trends, you can't even see those waves, then you cannot use Elliott wave. Okay, which means that this chart particularly not obvious. So when it is not obvious, do not use it. So you will use it when it is obvious, because technical analysis is like this. Technical analysis is when you see a pattern, like you see a double top, head and shoulder, or any chart pattern, and it is so obvious. Okay, so when you see it is so obvious, you will imagine that since you can see so obviously, other people, other market participants can also see that very, very obvious. So then you will see that everybody will act on it. Everybody saw this and then they will act on it. So same thing with the Elliott wave. So if this Elliott wave is one look, one glance, okay, you have to zoom out first, zoom out your chart and then you look at the macro picture. So from the macro picture, you see, oh, very obvious. You see the wave, you can count it, very obvious. Then you say that, okay, this one can trade. This one can trade the Elliott wave. Okay. Okay. Not standardized. Yeah. Yes, it's not standardized. Okay. And then repeat wave 3. Okay. Repeat wave 3, you want this one. Okay. Repeat wave 3. Okay. Wave 3 should not be the shortest wave among wave 1 and 3. So meaning that let's say my wave 1 is here, okay, and then my wave 3 must be longer than my wave 3, my wave 1, okay, my wave 3 has to be longer. Then if let's say my wave 5 is even longer, then doesn't matter, at least I'm not the shortest. Okay, so if let's say my wave 1 is very long, and then my wave 2 is like this, and then my wave 5 is like this, this is wrong. This counting is wrong. So if you are counting like that, that means you need to recount. That means you need to recount by maybe there is something here that you miss it, or maybe there's something here you miss it. So then maybe you need to combine this wave and this particular wave to treat it as a wave number 3, and then only that will be the wave 5. Okay, so sometimes you may need to combine with another wave, then to call it a wave 3. Otherwise, you cannot be too short. Okay. Last rule. Okay. Wave number let me erase this one first. Okay, so wave 2 and wave 4 should unfold in two different waveforms because this one is the corrective wave pattern. So these are, later I'll come down to here, but I just want to give you an overview first. So when you say corrective pattern, is that there are so many corrective patterns. So what that sentence means is that when you are doing the correction, right, there are different types of the corrective wave. You cannot have the same identical same wave. You get what I mean? So you have so many different types. So you cannot have two identical wave that is happening in the wave number 2 and wave number 4. Okay? Okay. So meaning, I give you an example. Okay, let's say I have 1, and then 2, and then 3, and then 4. Okay, my 4 is a horizontal correction, and then 5. So meaning my wave number 2 is a downward correction, because sometimes when you have a correction, it could be really like a correction. That means it go down. But sometimes when you have a correction, right, it could be just a horizontal movement. You go horizontal for some time, and then you go for the next up wave. So meaning this correction pattern and this correction pattern is different. You get what I mean? So this is a down, and then this is a horizontal. So that means they are different. And sometimes you can have both of them that are down. But however, this one, maybe you have 3 waves down, but this one you have 5 waves down. You get what I mean? So this is 3 waves down, but this is 5 waves down, so it's different. So then also different. Okay, so that means these two cannot be the same. But in the real world, sometimes we don't care, okay? As long as you can count the up wave, the important is this up wave, okay? As long as you can tell 1, 2, 3, 4, 5, you will count it as 1, 2, 3, 4, 5. Okay, because in the real world, it's a real practice. Theory is theory, okay? But in the real world, it's a real practice. So it's like loose count. You have to use loose count method. That means roughly you got it, then you see it, okay? And then it has to be so obvious that everyone has to see it. Okay, so now I'm going to okay, if wave 2 is zigzag wave, then wave 4 can be a flat. Yeah, correct. You're right. Okay, so later we will see that corrective wave. Okay, so now I'm going to show you these two charts here. So and they are the same time frame from 2018 until 2024. Okay, 2018, 2024. And the first one is the S&P 500 index. And the second one is the KLCI index. Okay, so we are looking at 2 index here. Okay, let me. Okay, so tell me, okay, which of these chart, S&P or the KLCI, it is more obvious to you to count the wave, the Elliott wave? Can see? From your, especially for those of you who do not have experience, I want you to give me the answer, because I want you to see whether you can see or not. Especially for those who do not have any background, okay? Can you see or not? Very good. Actually, S&P 500 is correct, okay? S&P 500. Okay, let me give you a shortcut way, okay? A shortcut way to count. Okay, if for those of you who do not know about the Elliott wave, okay, the shortcut wave is that you want to identify whether it is an uptrend. So here is an uptrend, and then here is a downtrend. Here is also another uptrend. So basically, the bigger picture is that uptrend, downtrend, and uptrend. Now, whether you are uptrend or downtrend, right? Okay. Say, for example, this part here first, okay, because this one is very obvious. This one is more obvious than this part. Okay, let me ask you this part here, can anybody tell me you have seen 3 waves down? Can anybody tell me if you see 3 waves down? 1 wave down, 2nd wave down, 3rd wave down. Can you see or not? Okay, if you can see, you put a thumbs up or you put a yes. Okay, this part here. Okay. Okay, yes. Okay, so when you are able to see, right? When you are able to see, in fact, you are actually able to count the waves already. Okay, so you see 1, 2, 3, 4, 5. So this one is wave 1, wave 3, and wave number 5. And then this wave number 4 is almost like touching the wave number 1. Okay, so there's a like a intercept here. Okay, but however, you can see the wave 3 waves down here. Okay, and over here you can also see roughly about 3 waves as well. So if you were to see these 3 waves, right? Can anybody tell me that you can see the 3 waves up here? Okay, can anybody tell me you can see the 3 waves up here? Okay, let me show you. Okay, 1, 2. You see the 3 waves, right? This third wave, there is some down here and then some up here. So I'm combining this together. Okay, so 1, 2, 3, 4, 5. So I'm actually combining 1, 2, 3, because 3 has to be the longest. I'm combining this together. And then 4 and then 5. So that I want to get the 5 wave here. Okay, and then A, B, C. Okay, so ABC is a corrective wave, but however, whenever you see 3 waves down, it's also considered part of the Elliott wave, especially when you see a very, very clear 3 waves. It means that this 3 waves, it shows that it is ending. Okay, whenever you see 3 waves up or 3 waves down, it is like, it tells you that either the uptrend or the downtrend, it is signifying an ending of the uptrend or ending of a downtrend. Okay, so here, I repeat now, I will try to put the number here. So this word is too big. Maybe I would do something like 24. Okay. Or maybe I need to zoom in a bit. Okay. 1. This one I move down a little bit. Okay. So 1 is here. Okay. 2 is here. Correction. This is correction. So 2 is here. 2. You see the correction? Can you see a correction here? Yes. Okay, and then 3 and then 4. So 3. So 3 is here. And then the 4 is here. So can anybody tell me, is it the same? My 2 and 4, is it the same? My 2 and 4 corrective, is it the same? Here and here, is it the same? Not same, yes. And then this is my 5. Okay. So then I'm counting here like 1, 2, 3, 4, 5. And now, sometimes you want to know why I want to put my 1 here. Why not my 1 is here? Okay. Now, I want you to count here. Are you able to see roughly 3 waves up? Are you able to see roughly 3 waves up here? Roughly, rough like a rough eye like that. Are you able to see rough 3 waves up? Yes. Okay, so you can. So here is 1, 2, 3, 4, 5. Okay, so this 3 and the 5 is almost the same length. So 1, 2, 3, 4, 5. So therefore, this, if you are able to count 5, then this is a complete wave here. So then this one is like 1, 2, 3, 4, 5. But within that 1, you have 1, 2, 3, 4, 5. ABC. Okay. You get what I mean? So meaning that within that bigger trend, bigger wave, you are able to count 1, 2, 3, 4, 5. A, B, C. You are able to count something like that. But although sometimes it's not so obvious, but you do it as a rough count. Okay, so 1, 2, 3, 4, 5. Rough one, roughly 1, 2, 3, 4, 5. Although here you have like a bit of a corrective here. But if you were to use this as a 1, right, then your tree is so small. So your tree cannot be the shortest. So therefore you have to make do with this wave 1, and then so that your wave 3 cannot be the shortest. You get what I mean? So because we have to obey the rule. The rule is that the wave number 3 cannot be the shortest. So we can't count this as the wave 3 here because it's too short. So then we have to make use of this wave 1, and then so that we combine this. Somehow we combine this 3, and then somehow then the wave 5 will be here. 1, 2, 3, 4, 5. Okay, so we do not want to make this 3 as shortest one. Okay, so we combine this together with the wave 1 here so that it is longer as well. But however, here, right, here you will not see so clear, okay, because over here you only see as a 3 waves up. I mean, 3 waves as in 1, 2, 3. You wouldn't be able to count like 5 waves completely. And that is because this wave number 5, right, it is being cut short. Okay, so sometimes the wave number 5 can be cut short. Okay, wave 5 is extended. Yeah, that's right. Okay, so wave 3 can be extended. So any of these waves, right? So wave 1 can be extended, wave 3 can be extended, and then wave 5 can be extended. So any of these 3 waves, they can be extended as well. So when they are extended, then we combine the waves with another wave so that they are extended wave. Okay, but over here you can see that wave number 5, right, is not a complete wave. There is no 5 waves up for wave number 5. Okay, so wave number 5, it is being truncated. Yeah, you're right. So 2, you are right. That is biggest criticism of the Elliott wave is that this one is after that, then only you see. When you're in the middle of it, you can't count. And then after the wave have already developed, then only you can count that wave. Okay, you are right. So that's the biggest criticism of the Elliott wave. So which is why not many people actually can master it. So for those people can master it, they will use it very, very often on their trading. Okay, so it does help in the trading because by counting the wave, right, you actually incorporate the time factor. Because a lot of time when we use the technical analysis, right, we do not look at the time factor. There's nothing talk about the time. We only look at the price action. And the price action is, okay, you see this double top, and then when the double top broken, then only you will go into the price target. So you calculate the neckline and the top, and then you project down, and then that is your price target. So usually when you are doing technical analysis, that is the normal way of using a technical analysis. But they didn't tell you when this bottom, this price target will reach, when, the time frame. Okay, but when you are able to use the Elliott wave, right, actually indirectly you are actually counting the wave, and then when you are counting the wave, you are giving a time element into the technical analysis. So therefore, for those traders, right, they are using the Elliott wave theory extensively because they want to count the wave. And then when they're counting the wave, they have this time element. So they know, this is ending. This is just a beginning. I have to go in. You get what I mean? Okay. So here. So this uptrend here of the S&P, right? Can anybody tell me how you're going to count? Okay, maybe I'll come back to here. Okay, maybe I'll come back to here. And then let me go through some of the theory first. Okay, this one will be last. Okay, last I'll come back to here. I want to go back to the theory first. Okay. What time frame? Okay, good question. Actually, I have a slide, but anyway, usually in theory, any time frame is good. But in practice, I do have my own time frame. Okay, so can anybody tell me what is your favorite time frame for Elliott wave? For those of you who are using the Elliott wave, because different people may be different. In theory, they said that there's no difference. Okay, any time frame you can use. But however, for a personal preference, I do have my own personal preference time frame. Anybody here who has been using the Elliott wave, do you have your personal time frame? Okay, never mind. personally, because I'm more onto the swing trade, so therefore I use the longer time frame. Yes, I use a daily chart, and I use a 4-hourly chart. Okay, occasionally I'll go into the 1-hour chart. So meaning that I will not use too short time frame because I'm more into the swing trade. Okay, so it depends on what is your style. So personally, I prefer longer time frame. Okay, so that's my personal preference. But in theory, any time frame is good. Okay, so that's the difference between theory and practical. Okay, practice. Okay, so okay, good. Edmund, daily chart, yes. So now we want to combine the Elliott wave and the Fibonacci together, because it's only when we combine this together and then we look back at the wave that I showed you just now, the S&P, right? Then only it makes sense to you. Okay, so how do we combine? Okay, so here we look at the Fibonacci ratio relationship. So you see, just now we say wave 1, 2, 3, 4, 5. Okay, now this wave number 2 or the wave number 4, okay, whenever you have a correction, right, they are the Fibonacci level of a correction retracement that we need to take note of. So what are the levels? So these are all the Fibonacci retracement level. So the retracement level can be 50%, 61.8. Actually, it can start from 236, 23.6, then 382, 38.2. And then you have the 50%, 618, and then 764, and then 85.4. So meaning you can have as shallow as 236. You can have a retracement of up to 236%, which is only 1/4. So for those of you who have done Fibonacci, I think that was my beginning of the year. I did one session on the Fibonacci, right? So the retracement can be 1/4, okay? The retracement can be 1/3, and the retracement can be half, okay? So the 1/4 here, we call it the 3.6% of a retracement of this whole retracement. So you start from here and you go all the way top and then you retrace. So this retracement is of the whole upward movement here. Okay, so this one is 1/4, and then this one is 1/3. Okay, retrace 1/3, and this 1/3 is about 382. And then sometimes you may be retracing all the way to 50%, and that 50% is 50%. And sometimes you can be 618, 2/3. Okay, so they will be even deeper, will be 2/3, 618. Okay, so it depends on your retracement. As long as it is not all the way to full retracement, cannot be full retracement. Okay, cannot be full retracement. So any of these retracement is good. And then you can actually tell me which one is more like bullish. Okay, a retracement of 1/4, 1/3, half, which one is more bullish? Can anybody tell me? Which one is more bullish? So let's say I have a retracement of 1/4. Is it bullish? Okay. In terms of the sentiment, the 3.6 is more bullish. 1/4 retracement is more bullish. And that is because if you understand the psychology, is when people are buying into it, and then after that, then people want to take profit. So this taking profit here is very shallow. So they only take profit for maybe 2 days. Okay, 2 days, 3 days, and then they continue to buy in again. So this one maybe is deeper, meaning that they take profit for about 5 days, and then only they buy in again. And then this one, they take profit for about 1 week or so, and then they buy in. So meaning that the longer time you take profit, right, the more uncertainty you are, because you are worried that the price is too high. So that's why you want to take profit. But if you are really full of conviction about this underlying stock, you are really sure about this stock, you are really feel bullish about this stock, you wouldn't want to take profit so long, because this is a good stock. Why I want to sell? I want to buy in again. You get what I mean? So the buying in again is this. Okay, it just correct a little bit, and then you just want to rush in, and then you just want to buy in again. So sometimes when the chart is doing a retracement, you can sense it. You can sense the sentiment. Okay, you can sense. Okay, then wave number 3 is 1.61 time. Okay, which is 161.8 time. So which is 1.6. Which is 1 2/3. Okay, so it will be something like this. So it will be 1 2/3 times. 1 1/3. So it will be 3/2. Okay, so this is actually looking at 1 1/3 times. So meaning, if let's say you're starting with 0 here, and then here is 1. Okay, so this top here is 1, and then this is 0. Can anybody tell me? Okay, so then when you measure from here to here is how much? Here is how much? Here is how much? If here from here to here is 1 time, can anybody tell me what is if it's a 161? Can anybody tell me what will be this height? From here to here will be 1.618. This height will be 1.618. Okay, this height will be 1.618. So when you're measuring, right, this 1.618 has to measure from the bottom of the retracement here. So you have to go through this retracement, and then from this retracement, then only you can measure up to the top level, and that will be the 1.618. Okay. So if let's say this one retrace up to this level, and then this level is 75 cents. So then you can add, okay, so from 75 cents, I need to add 1.618 times 1.618. And then that will give you 75 cents. I need a calculator. Okay, 0.75 times 1.618. 1.2, around 1.2. Okay, 1.2. So here we'll be getting at 1.2. Okay, by the calculation. Although you may look like, oh, this one looks like more than 1.5. Okay, but because of the calculation, okay, because I say that this one retraced up to here, and then from here you need to add. So wait, I need to add. So I need to add to okay, just now it's 1.2. I need to add to, I need to add 1.2 plus 75 cents. Don't forget this 75 cents. I need to add, so I need to add 1.2 from there. So it's actually 1.95. Okay, sorry. 1.95, almost 2. Yeah, very good. Okay, all of you are very, very good. Okay, it's close to the 2, so it's 1.95. And that is because I calculated the 1.618 times this 75, and then that will give me 1.2, and then 1.2 I need to add back my 75, which is this height. Okay, because this one is this height, I need to add back the 75 cents, which is this height. So therefore it will give me 1.95, and that 1.95 is almost 2. So many of you are correct. Okay, very, very good. Okay, so that's how you calculate by manually. Of course, when we use the chart trading view, you can use that manually, clicking the extension Fibonacci, and then you can calculate. Okay. So then this wave number 3, right, it can be as very far. Okay, but usually if you can go to this level, is in practice, if you can go to this level, it's very good already. Okay, in practice. Okay, then wave 4 is correction. Okay, and this correction is back to this. Okay, it can be any one of these. Okay, any one of these, 1/3, 1/4, 50%, and 618. So now next. So this is the chart that I was telling you. So here is 1, and then from here to here is 1.618. Okay, so and then from here, this base to up here is 1. So you can see that wave 1 and wave 5 is about the same, but wave 3 is about 1.618. So that is the a general rule, okay, a general guide for you to see the 5 waves up. So for all the traders, right, they will use this method. Now, as more and more traders are using this method concurrently, it will appear more accurately because everybody will wait. Okay, so for example, the price will go higher. So if you are buying in, right, you wouldn't sell until it reached this price target because everybody knows how to calculate the Fibonacci. So everybody will see this as a important price target. So for sure it will go there. I mean, not for sure, I think it's 100%, but then to a high chances probability it will go towards that number 3 there. So therefore, the self-fulfilling. Okay, I have to say that technical analysis is self-fulfilling. It's about fulfilling. Okay, it's the wrong spelling. But anyway, it's a self-fulfilling situation whereby everybody see this, everybody act on it, and then true enough, it will go there. Okay, so that is technical analysis, and that applies to the Elliott wave as well. So that is why I have to say that the more obvious the chart is, okay, if it's you can see very, very obvious chart, the more likely it will happen. If you see the chart like like this, okay, it's not obvious. You can't use an Elliott wave because it is not so obvious. So person A may see this differently, person B will see this differently, and then when they act together, it's like Roger. It's all over. You can't see the trend. You get what I mean? But then if let's say it is very clear, everybody see, everybody act on it. Okay. So far, so good. So far, so good. Can I continue further? Okay. Okay. Elliott wave is better prediction than okay. I would say that Elliott wave is a subset of technical analysis. So we have technical analysis as a big umbrella. So under the technical analysis, Elliott wave is the subset. Okay. And then you have the Fibonacci. And then you have the moving average technical indicator, but it is subset of the technical analysis. Zigzag. Okay, wait. Now, next, we come to the corrective wave pattern. So for the corrective wave pattern, there are 2 major types. One is called the horizontal one, it's called the flat. Okay, meaning that you are doing a horizontal correction, which is moving on a flat. The term is called flat. Or the correction can be zigzag down. Okay, so meaning ABC. Your ABC is a down. So your C is a lower low. You see? Can anybody see this? Your C here is same as your A. So you are on a horizontal trend here. But here, you are on the lower low, you are on the downtrend here. Okay? Now, there are more to it. So it is not so simple. There are more to it. So basically, but no matter how it is, right, you will see that either you have a zigzag or you have a horizontal. So for example, this one, your A and your C. Your C is lower, so then you have a zigzag. You see? You see this zigzag? Okay. A, B, C. Okay, now tell me, what is this? I show you already. Okay, never mind. So this is a flat. Okay, so because your C is same. Okay. Then how about this one? This one is called irregular, and that is called the irregular, and that is because your B is higher high. Usually your B is lower high. Okay, but here your B is higher high. So therefore, this one is irregular because when you are having a higher high, it is very, very bullish. So that's why you have higher high. But at the same time, you also have a lower low. When you have a lower low, it also means very, very bearish. So how can you have a very, very bullish and a very, very bearish together? So that means that this irregular pattern is showing that people are just too confused and then they do not know the direction. There's no clear direction. Some part of the market participant, they are very bullish about it, and then some part of the market participant are actually quite bearish about it. So they have this two conflict view, and then it become like irregular. Okay, then when you are looking at this horizontal triangle, so you are looking at this is a triangle. You see, it's converging, right? So it's a triangle shape, like a triangle shape. Okay. Oh, I have to draw like this triangle shape. Okay, so this is a triangle shape. So this triangle shape, you can also see the correction pattern. It is A, B, C, D, E. You count until the E there. Okay, so whenever you see a triangle, you count until the E. So it'll be A, B, C, D, E. And then when you have a breakout, breakout. Okay, so here you are looking at double three. So double three, it means what? Because each of these wave, right, they have the wave count. So for example, this one is 1, 2, 3, 4, 5. Okay, 1, 2, 3, 4, 5. A, B, C. Like a 5 wave here, 5. 1, 2, 3, 4, 5. So this one is 5. And then this one B, B is 1, 2, 3. So it's 3. So this B is 1, 2, 3. And then C is 1, 2, 3, 4, 5. Another 5. So therefore, this zigzag is 5, 3, 5. That means your zigzag is 5, 3 waves only. 5. Because I have 5 waves down, and then 3 waves up only, and then 5 waves down again. So which means that it is quite bearish because your downtrend has 5 wave. 5 wave for the downtrend. But your uptrend only 3 waves. So you only go up a little bit. And then you go down again. Okay, so but this one is 1, 2, 3. 1, 2, 3. And 1, 2, 3, 4, 5. So you have 3, 3, 5. Okay, so this one is 1, 2, 3, 1, 2, 3, and then 1, 2, 3, 4, 5 as well. 3, 3, 5 as well. So here, double three is 1, 2, 3, 4, 5, and then 1, 2, 3. 1, 2, 3, 4, 5, 1, 2, 3. 1, 2, 3, 1, 2, 3, and then 1, 2, 3, 4, 5. Okay, so that is looking at the count, wave count. But nevertheless, right, you just look at it as a zigzag here. Okay, and then you look at a flat here, and then followed by another down. Okay, so sometimes it can be a combination of some zigzag and flat together. And then this one is also looking at like a flat as well. Okay, and this flat, they have more waves. Okay, you have 5, 5, 3, and then 3, 3, 5, 3, 5, 5. Okay, 5, 3, 5. So you see 5, 3, 5, and then 3, and then 3, and then you have 1, 2, 3, 1, 2, 3, and then 3, 1, 2, 3, 3, 3, 3, and then 5, 3, 5. Okay, so and then 3, and then 5 again. So, but it is, although it is very complicated to count, but then you look at the big picture. The big picture is that, do you have a like a zigzag lower low, or do you have a horizontal? So in the end, you just ask yourself, is this a horizontal correction or a downward correction? You get what I mean? So is this a horizontal or a downward correction? So then you can see, it doesn't matter how you count the wave, doesn't matter. Because in the end, right, you just need to know, is this a horizontal correction? Is it a downward correction? As simple as that. So in the end, you just need to know about this, either this or this. Because if it's this, that means that it's horizontal accumulation. That means it's going horizontally. So it's not so bearish yet. And then when it is going like this zigzag, that means it's quite bearish. Okay. Peter asked, can we use zigzag to view the count of the Elliott wave? So you are asking, when we are looking at the zigzag, can we count? Yeah, we can. So we 1, 2, 3, 4, 5, and then A, B, C, and then 1, 2, 3, 4, 5. Are you asking this question, Peter? When we are looking at the zigzag, can we count? Yes, we can. It's actually it's either 3 or 5. The waves are simple. It's either 3 or 5. So as long as you can count either 3 or 5, you are okay already. Okay, so sometimes I will ask people not to focus too much on the counting. You try to look at the bigger picture, because when you're looking at the bigger picture, then you can see the big pattern. Okay, if you are too engrossed in the counting the wave, right? Oh no, then you can't see a big picture. Okay. Using a zigzag indicator. Okay, so is that the trading view? Okay, so maybe the trading view can have a zigzag indicator. Okay, maybe we can see that later. Okay, So, thanks, Peter. Okay. So here we have the rule of alternation, meaning that this wave number 2 is different from the wave number 4. Okay. So here we have 3 waves, and then here you have 5 waves. So it's different. Okay, let's see. How do we trade? Okay, so usually when we are doing a trade setup, you can either go for the bottom here, because for the reason for Elliott wave, right, is trading the reversal, trend reversal. So you are on uptrend and then you are reversing, and then you are downtrend and then you are reversing uptrend, one uptrend and then you are reversing. So meaning that you are always on the reversal here. All these are all reversal point. Okay, so all these are all reversal point. So when you are trading on the reversal point, very important is that besides all these trade setup, right, try to combine with the candlestick. Okay, try to combine with the candlestick pattern, whereby because of all this reversal, the candlestick will confirm the reversal for you. Because when you are trading, right, you do not know when is the reversal. Because sometimes it may go 1/3, 50%, and then all the way down to 618. It may go lower and lower and lower. So you never know when is the bottom. But however, if you are combining with the candlestick, right, you can actually see the reversal pattern. Then only you say, oh, I see a reversal pattern already. So now I'm going in again. You get what I mean? Reversal can combine to use with RSI, overbought and reversal. Yes, correct also. You can also use RSI as long as any tools that help you to identify. But I prefer the candlestick is because it is more direct. Straight away you see the shooting star. Straight away you see the hammer. Straight away you see the bullish engulfing. Okay, so you can straight away see the reversal. Then only you can be more confident. Then only you can trade at the bottom. Otherwise, you don't know when is the bottom. Okay, so you can't be like when it is dropping, you will go in like that. So you are catching a falling knife. Okay. Okay, so the trade setup is you are trading on these top and the bottom. Okay, you are trading on the top and the bottom. And usually you combine with the candlestick. And also at the same time, you also combine with the moving average, such as your 20-day, 200-day moving average. Usually will be the 20-day. So where is your 20-day? Okay, so that 20-day will be your support and resistance. And then also your trend line. So you can draw a trend line together. So if this trend line together also coincide with the 20-day moving average, then you know that is if you are to short, that will be looking at the breakout point. Okay, so breakout point, usually people will short after this breakout. But the thing is that when you are really trading at the top or the bottom, right, and then we are trading at the candlestick, right, you don't have to wait until here. Okay, you don't have to wait until here, and then you just trade here. But however, this does look at like a resistance for you, meaning that support and resistance. So meaning that after you hit here, maybe you need to take profit, because what if it hit here and then it bounce back again? Okay, but however, if it break, then you short again here, short here again. Okay, so you can short here, and then you can short here again, and then you can short that. Okay, so this is my wave number 2. So my wave number 2, I short here. And then it rebounds again, and then you may want to short here. But if you want to short here, then you say that, okay, my target cannot be too big. Okay, because now I'm getting end of the trend already, third wave already. So this is one wave, second wave, third wave. So when I'm trading the third wave, I have to be careful, because when this is the third, may mean that it is an ending. Okay, so then you will put your stop loss. So your stop loss is usually your if let's say you are putting here, okay, you are looking here, then your stop loss is somewhere above it. And then there are many ways of the stop loss. It could be a 20-day moving average. It could be a trend line. It could be the candlestick. So there are many ways to the stop loss. But the thing is that it depends on what is the whole trade setup, because sometimes it depends on what is your time frame. So if let's say you are on a swing trade, maybe your stop loss is a bit far apart. Okay, it will not be so close. If let's say you are a day trader, then maybe your stop loss is just the previous high. Okay, if you want to short, the stop loss will be the previous high. So it depends. Okay, so really depends on what is your time frame. Okay, so here let me do a recount. Okay, summary. Summary is that you have your buy or sell entry. Okay, when you want to buy or sell entry, you can either long at the bottom or short at the reversal. Okay, so then you will identify the reversal. The reversal together with the wave count. Okay, the wave count and then together with the Fibonacci. So then your wave count, you have to count according to the Fibonacci. So here it is wave up here and then retracement, and in this retracement, is it like a 236 or 382 or 50% or 618? Okay, so you count according to the retracement with the Fibonacci. Okay, you count with the Fibonacci plus the reversal candlestick. Okay, so that is the entry. So let's say I'm entering here buy. So I have to see whether it has reached to maybe 382. Okay, the normal, the most common is 382. So at the 382, do you see a reversal candlestick? Do you see? Okay, so if you didn't see, then you have wait for that 50%. So at the 50%, do you see a reversal candlestick? Okay, so then if you didn't, then you go for the 618. So 618, do you see one? Oh, finally you saw one. Then you enter. So after you enter, then where is your profit target? Profit target. So your profit target will be the length of that wave. Okay, so if you are trading on the wave number 3, so that will be 1.618 of that wave number 1. Okay, so this will be your profit target, is looking at the Elliott wave. Okay, wave target. Okay, so you have to count the wave target. So where is that wave? Okay, is it 1.618 or whatever? So it could be one time only. So the safest is go for the one time first lah. Okay, in the practice, 1.618 is very difficult to get. Okay, we'll go for the one time first. Okay, or if you can see like a 20-day moving average on the top, or you can see a previous high. Okay, so all this you can set as a profit target. Then your stop loss. So this is you go in here, right? So then you put a stop loss. So your stop loss is usually a 20-day moving average or whatever trend line or previous low. You see where is the previous low, and then you try to identify another support and resistance. Okay, so you will identify the stop loss as the support and resistance, SMR. Okay, so meaning you go in, you enter, and then you have a profit target. And as well, as much as you have a profit target, you also have a stop loss, and your stop loss will be the support and resistance. Okay, so that support and resistance will be act as your stop loss. So then you are protected. So your trade will be protected. Okay, so yeah, definitely. Okay, all this video will be recorded in their YouTube channel. Okay, you have to go to the YouTube channel, LifeChamp or Bursa Malaysia YouTube channel. Okay, reversal can combine to use with RSI for overbought and oversold. Yes, you can combine, but however, this overbought and oversold, right, it will be a bit of a lagging. So sometimes you won't find it so obvious. Okay, but however, you can combine just to double confirm. The RSI is to confirm your trend. Okay, it can confirm. It can act as a confirm, because if you have a bottom, right, and then at the same time you also like below 30% of the RSI, so which means that it is a strong conviction for you to buy at below 30%. Okay, so these are the pitfalls. Okay, is subject to the wave count, because the wave count is very subjective. One person may count differently, because just now we saw that there's the extended. When it's extended, you have to combine already. And then sometimes overfitting, data fitting. So meaning that it didn't exactly look like a trend, but then you force into it. you force the pattern into this Elliott wave. Okay, if you find yourself like forcing into this pattern, that means this chart is not obvious. It is not obvious, and then you may as well not trading with the Elliott wave. Okay, don't use the Elliott wave to trade that, because it's not so obvious. Don't try to force it. Okay, so overfitting, all these are false already, so don't. Retroactive analysis bias. Yeah, this is exactly what somebody is saying. So it's like a hindsight thing. So it's like only when you look back and then you see, okay, that I saw that trend. When you are in the middle of it, you can't see. Okay, so that's why when you're in the middle of it, that's why it will test your technical analysis knowledge. Because if you are very knowledgeable in your technical analysis, right, even when you are in the midst of it, right, you can count. Okay, you can count. Just like what I told you, which is looking at the candlestick, looking at some of the indicator to help you in Fibonacci to see the trend. Wave failure and invalidation. Yes, sometimes it may not have that 5 wave. It will only be cut short to 3 or 4 wave. And the lack of consensus among analysts. Yes. And then the time frame sensitivity. Because some people, although in theory it is like no, there's no difference between the time frame, but in the practice, right, people do see that there's a difference. Okay, they do see. So for example, I do see that the shorter time frame may not be so reliable. Okay, and then it will be difficult to see a pattern as well if it's a shorter time frame. But however, if it's a longer time frame, then you can see better. Okay, let's go and check the chart now. Okay, so now we have to go for practice. Okay, we have to go for application here. Daily 4 hour. Yeah, that's right. Oh, okay, I missed all this answer. Please show us the extension in the chart. Okay, Ken. How about the triangle? The triangle will be usually the correction. Okay, the triangle will be the correction. Wave 5, S&P irregular. Okay, so now we come back to this S&P now. So just now we say that there's a Fibonacci retracement. So here we do see a Fibonacci retracement. So we can use the Fibonacci retracement from this bottom and then up to here. Okay, so okay, how about if I have to move this down a little bit, or maybe I do this. Okay, so you start from here. Yeah. Okay. So here you do see that the retracement is around 236. So which means that it is bullish and then it continues to go further. So whenever you see some bullish sign like this, 236, which is shallow, the chances of extended wave 3 is there. Okay. So then this one is 236. I mean, this one is wave number 1. Okay. Then the extension. So for extension, you go for this Fibonacci extension. You see? Extension, the second one. Okay, you click. Okay, 1, click 2, click 3. Okay, so then you will see that this is my point number 1. This is my point 1, point 2, and then point 3, A, B, C. Okay, so this is my point number C. So because I need to project this one to the top of the 3. So therefore, this is 1 time. You see, it's 1 time. So which means that usually when you are looking for the extension of the wave number 3, right? Don't go for 1.6 lah, okay? No, because it's too far. Go for the 1 first. Okay, 1 is more realistic. Sometimes you even short of 1, you'll be somewhere in here also. It could be here also. It could be here also. Okay, so which means that these are all the tricks. Okay, then we come to just now somebody asked about here. Okay, so this is exactly what I want you guys to apply. Okay, apply what you have learned. Okay, so if you are looking at this, we can count, right? So can anybody tell me what wave is this? How do you plot this? Okay, so here we see that you have a 1, 2, 3, 4, 5. You have a 5 wave down, and then 1, 2, 3, and then you have a 3 wave up. So then this is a correction, and then down again, and then now this is a breakout. Okay, so just now, if you want to draw a triangle, you can draw a triangle. Okay, you can draw a triangle, and then waiting for this to break out. So there is a breakout here. Okay, so it break out, and then there is a breakout. So this is a breakout. Okay, so this is a breakout. So you can actually draw all the way from here. Usually when, yeah, you can draw a trend line like this, trend line break. So you can actually use a trend line break to test. So here, this one is a trend line break, and then it tests here, and then it goes further. So then this testing here, it confirmed that this downtrend is over. And the minute that it can test that it is a support, this trend line is very, very important, because for so many months, it has been resistant for so many months. And then finally, after about 10 months, a year, it tested, and then it become a support. So then this support testing, right, it confirmed that this downtrend is over, and then now we are going for an uptrend. Okay. Okay. Yeah, USD and gold. Okay, later we see the USD and gold. Okay, so here we are looking at the testing here, then only it go higher. Okay, so here, so if let's say you were to count, right? Can anybody tell me what kind of a wave is this? So this one is a trend here, and then how do you count? Okay. Okay, do you count the bottom one from here, or you count the bottom one from here? Okay. Second point number 1. Okay, for this one, I count from here. Okay, 1, 2, 3, 4, 5. Okay, so I count from there. So I will count for this one as a 1. And then this one as a 2, and then this one as a 3, and then this one as a 4, and then my 4 is same as my 1, almost there, and then this one is my 5. Okay, but however, after the hindsight, then it may be different. Now I see something like that, but doesn't mean that it is correct. You get what I mean? Now I see something like that, but doesn't mean I'm correct, because I can be wrong also. Okay, so it could be hindsight. So, but anyway, this is at the moment, this is how I count. 4, and then 5. Okay, so, and then the way I look at it is that we will go back up to this level very soon. Okay, 5, we can go back up. So after the 5, right, then we will want to see whether it will break above that level or not. Maybe it will go for consolidation, and then it will go up again. So then this, if let's say it's a really bullish trend, it will be like this. This is the first wave of a big wave up. Okay, if let's say it's really, really bullish, okay? I'm just giving you the kind of a scenario that it may happen. So if it's really, really bullish, right, then this one will be a big wave up to the wave number 5, and then you have a wave 2, and then 3, and then 4 and 5. Okay, so if it's bullish, it has to be like that. But nevertheless, in a like a this time frame, I'm looking at the next one could be the wave 5. Okay, second point. Okay, after breakout. Okay, because after breakout is usually the wave number 3 already. Okay, after breakout is usually the wave number 3. It's actually, there's no right or wrong. Okay, it's just that the way I count it, I want to count it as the breakout is usually the wave number 3. Okay, so if let's say you are looking at this second point, okay, so 1, 2, and then your 2 is very similar to here. So that's why I can't put this 2 same as this one. So that's why I put the 1 is from here, because I want the 2 is a bit far from here. I want to have a higher low here. The 2 has to be higher than the base here. So that's why I have a 2 here. And then my 4 is almost back to my zone 1. Okay, so which means that this uptrend that I'm experiencing, right? Compared to this uptrend that I'm experiencing, can you make a comparison? Usually when you are trading, right, try to draw trend line, okay, and then try to compare the slope of this trend line. Okay, you try to compare. What do you see? Is the current trend line steeper or flatter? Can anybody tell me? Is the current trend line steeper or flatter? Is the current trend line steeper or flatter? Flatter. It's actually flatter. So that's why these few weeks, if it can go higher, it will make a difference. If it can go higher, that means you are back on this trend. Then only you can go higher. But if let's say for a long time, right, it is like below this trend line, right, and then I'm afraid that have to be careful. Okay, you have to be careful about the US market. Okay. So let's go for the gold. Okay, gold, I usually go for the XAU USD. Okay, so here we do see a shooting star, right? So many people ask me about my opinion on the gold. So I'm afraid that, sometimes I may not forecast accurately and then people will blame on me. Okay, but anyway, you look at the big picture first. Okay, so you see this, okay, you see this one. It's a 3-year chart here, right? And then this is if you look at the chart pattern, you don't look at the Elliott wave first, you look at the chart pattern. Okay, what chart pattern do you see? What chart pattern do you see? What chart pattern? Flat is okay. Flat is 3, 3, 5. Oh, okay. Q. Long time didn't hear me talking. 12, 12, 34. Flat. Okay. Ang, you say is what? Oh, okay. Ang, let me know what is this. Head and shoulder. Do you see a tall head? When you have a head and shoulder, you must have a tall head. Do you see a tall head? Okay. What do you think? Inverted? Inverted? Okay. Oh, I see what you mean, inverted. Okay, so triple top. Okay, yes, triple top. So let's draw a horizontal line like this. Okay, and then this one. Yeah. Okay, so for the past 3 years, it has been moving horizontally. And now for last few days, it attempted to break above this line. But however, after it attempted to break above, then you see there's this shooting star coming back. So meaning that people are profit taking already. Okay. So but however, if you to look at technically, I'm going to look at this gold chart in terms of the technical and the fundamental. Okay, let's talk about the fundamental first. Okay, so if you were to look at the fundamental, right? Fundamental, is it bullish or bearish for the gold at the moment? Fundamental. If you look at the fundamental. In order to look at the fundamental, look at what is happening around the world. Yeah, bullish. And because we see so many wars are ongoing. So whenever there is a war ongoing, right, then you will see that whenever you see that the war is ongoing, you will see that it will be people are worried about their wealth, and then they want to get hold of something solid. So whenever they want to get hold of something solid, then they will choose the gold. So the gold will be, if you to imagine the world is going to be more wars in the future, okay, there will be more wars. If you think that there will be more wars, then the fundamental is that we should hold more gold. Okay, so that is a fundamental. But however, if you look at this technical analysis, right, at this moment, the way I look at it, this is a bearish sign. The shooting star is a bearish sign. Okay. So gold only start rally now. Strange phenomenon. Actually, gold started rally in 2020 when you were in the midst of a pandemic. This was 2020. Okay, 2020, you have that pandemic and then it go higher. But as it go higher, then it reached that 2000 resistance and then it go down. Okay. So here I do see that technically it is not so bullish because you are still within the horizontal consolidation. Okay. If you to look at the money chart will give you a bigger picture. This one I do not have too much of a data. I only have like okay, so only like, but here was too low. So you can see that now we are trying to break above it. Okay, whether we can successfully break above it, it depends on whether how severe is the the war or the ongoing. Okay, so I believe the war is ongoing. Okay, we will only have more and more wars. So now already we have 2 wars, and then the third war is actually in our ASEAN country, which is in Myanmar. The northern part of Myanmar is actually Myanmar is an interesting country because it is ruled by the military. So, but however, the people there, they do not like the military rule. They do not like the military government. So then they are actually joining a lot of all those alliance. So they call it the Three Brothers Alliance. They want to fight the military. So actually they are fighting all the way to the Yangon now. Okay, so it's still ongoing. This war is called a civil war and it's still ongoing. And on the other side, we also see that the North Korea is like always making trouble. So always trying to intimidate the neighbors. And the nearest neighbor is Japan and South Korea. Always try to intimidate. So that's North Korea. And then another possible is China and Taiwan, because people already see that the China is building their warship now. So they are actually building the third warship. So by the time when they finish the third warship, it will be end of 2026. So people are looking at the time frame for China to take over the Taiwan is by 2026. So in a longer time scale, right, we are looking at there could be more and more war. So to me, I feel that we just have to hold the goal. Fundamentally, we just have to hold the goal. Although technically short term, we see that it is a bit bearish. Okay, but I would just look at it as a long-term hold for the gold. So that's just my opinion. For the silver, actually nobody really look at the silver. Silver, what's the silver? Oh, silver. Okay, let's see this one. The silver, your chart is not so good. It's because of this over shot already. So this was like a very high like a shooting star. Okay, so it's not so good, but however it is also trying. So whenever, if let's say there is really when the gold is getting too expensive, right, people will look at the silver, because when gold become like too unaffordable, silver will go up. So in eventually silver will still go up. Okay, so I would think that the silver will go up. XAG. Okay, thanks. Okay, but anyway, this one is quite a good chart already. Okay. Iman also say that. Okay, thanks. Okay, so because you can sense it. And another thing is that if you to look at the major cycle analysis, I'm looking at the major cycle analysis. Every time when there is a pandemic, there will be followed by wars. It happened in the history. If you were to watch those Korean drama also you saw like thousands years ago, or China drama, where you see thousands years ago where they were under the like a before century, or even like a few hundred years ago or 1,000 years ago. You saw those Korean drama, or those drama, they have during the pandemic, then they will cover with like a stuff like that. Okay, so those were they already happening in the olden time. The pandemic was a very like a very common thing. Okay, it will happen, but because we are in this lifetime, so we see things from our perspective. So our 100 years is a very, very long year, but when we look back at the history, right, that 100 years is a very, very fast thing. So if we 100 years, 200 years, 300 years, it will be very, very fast. But that 100 years then also happens something like this, what we're happening now. So which is you have a pandemic, and then after the pandemic, then you follow by wars. Okay, so basically the century is from year 1 to year 100. So that 50 is the middle. So anything when we are below the 50, right? So for example, below the 50 is 1920, 2020. So currently we are 2023. So we are below the 2050. So we are below the mid-century. So when we're below the mid-century, it could mean that there could be more wars happening. Okay, so that is looking at the history. Okay, but anyway, that one next time when we look at the time cycle, then maybe I can talk more. So this is what is happening now. And then we can also look at the time, the daily chart. Daily chart is where I usually will use that for the Elliott wave, okay, so that you want to see if there's any clear pattern. But over here, looks like there's not much of a clear pattern here to count the wave for the silver. Not much, because you are in the horizontal. So let me go to the gold again. Okay, so let's see if I can see. Thank you. Okay, so let me see if I can count. Okay, so here is okay, not much, but however, if I have to zoom in, if I can count, let me see if I can count here. I can see that there is a wave 1 here, 2 here, and then 3 here. So it is, if it can break above, then it could be a 3. Okay, but however, if cannot break above, then it could be still on a correction mode. Okay, so it could be still on a correction mode. So we'll see whether it can break or not. I think within weeks, okay, it may take some weeks, a few weeks, 3 weeks time to see whether it can break, and then can see a support, testing a support here. Because the important is that you need to test the support here. Right now, it didn't, it has a rejection from this resistance line. So it's not a good breakout yet. So we want to wait. So if there's no breakout, then I'm afraid you can't count like 1, 2, 3. You can't see that as a wave number 3, but then it's more like still a correction. Okay. Okay, so let me go to the ETS. Okay, let me go to the ETS. The ETS is here. Okay, so much you have learned about the Elliott wave. So sometimes you want to try on a real Bursa stocks, but however, you have no confidence because many of you do not have much experience in the stock. So I'm now giving you this simulation, a simulator whereby you can actually practice trading or practice investing on a virtual trading platform. Okay, so how many of you have already opened a virtual trading account in this Bursa Malaysia website? and it's actually under Bursa Academy. Okay, how many have not opened a virtual trading account here? Not. Oh, okay. So that means those people like Tu and then Chen Ming and also Sao Ching and Muhammad and also Yao Ke. Okay, all these haven't. Okay, so let's do together. So you can open a Bursa Malaysia homepage. Under the Bursa Malaysia homepage, you go and look for Bursa Academy. Okay, so it's under Bursa Malaysia homepage and then Bursa Academy, because academy means learning, right? So we are all learning together. So under the academy, we look for simulator. Okay, so this simulator, it will have exact simulation of the Bursa Malaysia now. Okay, it will be exactly the same. So you go to the simulator, you go to the equity simulator here, click. So here you are looking at something that is exactly the same. So here 1445 is exactly same as what you are seeing. Okay, so this is an actual simulation, but this one is a virtual trading account. So you will have to use this virtual money. How much virtual money they'll give you? They'll give you 100K. They'll give you 100K and then for you to practice trading. So I will usually start with a watch list first. Okay. So the watch list here, you can actually create watch list. Create watch list. Okay. Because I already have 3 watch lists, so it didn't allow me. But you can always create watch list and then you can add those stocks in the watch list. So here I have 3 watch lists: technology, dividends, stocks, and property and constructions. Okay, so I have these 3 watch lists. So among these 3, right, what is my approach? Okay, my approach is very, very simple. I want to build a portfolio, and this portfolio, I want to have dividend income. At the same time, I also want to have some growth. So that's why you see that I have dividend stocks in one watch list, and then I have this technology and property and construction. These are go by theme, thematic investing. So I'm looking at this dividend stocks here will give me the income that I need. Okay, and then these 2 will give me the kind of a capital appreciation that I want. The dividend is I need. Okay, I say I need, meaning that it's essential, it's very, very important. And then this technology and the property and construction is I want. I want to have a high growth. Okay, I want to have a capital gain, but it may not happen to me. So since I know that this one is something that is important to me, the dividends, so I'm going to classify my portfolio 50% into the dividend stocks, 50%. And then the other 50% or lower, okay, depends on what's your risk now. If let's say you are conservative, then maybe you will give this to like 40% only, 20, and then this one 60. It's up to you, okay? But for whatever it is, right, I will advise minimum 50% put in the dividend stock, minimum. Okay, so under the dividend stocks, what are they? So it can have the consumer, it can have the banking, some industrial here as well, and then some utility here as well, and REITs as well, some REITs here as well. Okay, you can put in more REITs like Axis REITs, IGB REITs. Okay, you can put in more there. So as long as these are the one that give you consistent and safe dividend, you put it there. Okay, so this will be a watch list. So anytime when you have the money, you just buy that. So my approach is that whenever I want to buy these, I will buy this, because this dividend stock is anytime you can buy. So if let's say I buy UEMS, let's say I buy UEMS. So if let's say I buy 3K of UEMS, I will follow by 3K of dividend stocks. Okay, So for example, I buy 3,000 ringgit of UMS, and then I will buy one lot of public bank shares. Okay, then I will wait, because every month you want to buy, you want to invest. It's like a saving for you. You treat this as like a saving tool for you. So every month or every 2 months, when you accumulated enough of money to invest, then you invest. So then you treat it as like a regular investing place for you to invest. Okay, so it's like a forced saving. So then you can get the benefit of the dividend income, and at the same time the capital gain. So every time when you wanted to buy some technology stock, so for example, you want to buy VTROX. Okay, so you want to buy some equipment-based technology stocks, you buy some VTROX. So you buy about 3K of VTROX, then you buy about 4K of dividend stocks, banking stocks. Usually I'll match with the banks. Okay, so it will be technology and the banks, and then property, construction, and the banks as well. Occasionally, if I have too many banks already, then I will change to the REITs. Okay, or the industrial, some of the industrial also can. Okay, so how do you buy? Okay, so here, let's say you want to buy one of the let's say PCAM. Okay, so then you double click. Okay, so then this will appear here as buy. Green color means buy. And then they will give you this limit price. You can only do limit price, you can't do market price. And then you will have to look at the bid and the ask. So the bid and the ask is 6.97, 6.98. Okay, 6.97 and 6.98. So let's say you want to buy and then you don't want to queue. So you straight away you key in 6.98 here. Okay, so I key in 6.98 and then I buy, and I skip the confirmation and then I buy. How many lots? Let's say I want to buy 10. Oh no, one lot is 100 share. Okay, one lot is 100 share. So I buy 10 lots is 1,000 share. 1,000 share is 6,000 plus. Okay, so very good. I can buy PCAM below 7 ringgit. Very happy. So I buy. Okay, so after I key in, then I go to my order here, order book, and then I look at my order status. So I have buy limit Q at 6.6. Oh, this one, did I say I want to Q or I want to buy direct? Actually, I want to buy direct. The direct is 6. This is an 8 or 9. 9.8. That's 9.8. So I should be getting it. Okay, let's see. 9.8. 9.8 is the selling price. So where's my order book? My order book. My order book is here. Okay, but it says that I have to queue. Okay, never mind, let it queue. Okay, I want to buy at 9.8. So let it queue. So in the end, it will be fulfilled. Okay, so it will take some time. So match already. Match with 500 share now. So I still left about 500. Partial match. Okay, so it will match. So in the end, it will match. Okay, so that's how you buy. And then you can check your portfolio from here. Equity portfolio. Okay, so this is how it works. Okay, any questions on this virtual trading? Any question? Okay, no question. And then we can go back to the Elliott Wave, and then you can ask me questions on the Elliott Wave. Should you buy at market? Yeah, usually if the amount is like little, right, I usually buy at the market. If it's not too far lah, okay, I usually buy at the market. Hello, Venice. Hello. Oh, Hanafia. Hello, Hanafia. Okay. So now I open the questions to the Elliott Wave. Nice simulation. Yeah, that's why I like about this paper, virtual trading. It's suitable for new beginner, especially if you are learning technical analysis and then you want to test your skill. You want to test whether you have the skill or not. So I think this is a good place. They also have a simulator for the derivative. So derivative will be the FCPO and the FKLI. So that one is also you can get the simulator as well. Busa have like manual for this, like manual to use. I'm not sure whether they have the manual. Okay, not sure whether they have the manual, but anyway, this kind of is actually operated by end-to-end. End-to-end is also attached with many of the securities firm. Like I think Affin Hwang and M&A, all these that are using end-to-end. So when you have a trading account with Affin Hwang and M&A, right, you are actually seeing the same thing, exactly the same thing. Okay, yeah. Is Elliott Wave work better for a very volatile market? Lily Law asked this question. Okay, let's go back. Okay. Okay, if it's a very volatile market, as in like during a day-to-day trading is a very volatile market, I would think that Elliott Wave somehow it still works because Elliott Wave has to be looking at the psychology of the market participant. It has been working for so many years. So even though sometimes you have some stable market, volatile market, I think it will work. It's just that when the market is too stable, then I think that it won't work when the market is too stable because it's like looking like horizontal trend all the time. Then it will not work. But then, however, if it's volatile, it's like a trending. It works well for a trending market. So that's why you can use it on the forex as well, and also on the index. Like the KLCI index, you can use it, but then sometimes you have to see what time frame, or maybe you have to see a bigger time frame, like a 20-year time frame, then only you can see meaningfully. Okay, if let's say you are looking for like this one is like forever horizontal, so it's not easy to spot. Okay. And if let's say you are looking for like our technology stock like Inari or Greatech, that one maybe you can also see some also, because all these technology stock, they are fast moving, they are trending, and then you can see the trend as well. Okay, so this one is a Greatech. Okay, Greatech over here, actually you see some three waves or not. So this one I actually zoom, even though you have a shorter wave here, but you can see three waves up here. 1, 2, 3, 4, 5, A, B, C, you can, right? Okay. Is Elliott Wave more suitable for big cap or mid cap or penny stock? I will think that it doesn't matter whether what cap stock, but the thing is that it has to be chart specific, chart by chart. Some chart is clear, some chart is not clear. So it doesn't matter as long as the chart is trending. Okay, I would think that as long as the chart is trending, then it will be clear. I'll say that zigzag then X then DON in flat combo. Yeah, this one, which chart is that already? I forgot which chart is that. Zigzag then X then done in flat combo. Are you talking about the gold chart? Okay, are you talking about the gold chart? The gold chart is still on a flat, right? Yeah. Okay. Yeah, the gold chart is still on the flat. Unless it break out. Okay, it break out, then it will be different. So which means that every time when there's a breakout, there is a trend. So then you can use the Elliott Wave to count. So when you are always on a horizontal trend, that means that it will be difficult. So here we look at the previous trend. Okay, before this major chart pattern, you do see a trend here on the left-hand side. Okay, let me erase this first. Okay, let's see, we look at here. Okay, are you able roughly to count the 3 waves? Roughly lah, can count? I think can lah. Okay, 1, 2, 3, 4, 5. So that is a big, some will start from here. Okay, even if you start from here, 1, 2, 3, 4, 5 also can. Then you just treat this as an extended wave number 1. If you start from here, okay, if you start from here, then you treat this as extended wave number. If let's say you want to treat this as wave 1, you can also do that. Okay, so this will be wave 5. In equity market in Malaysia, how long Elliott wave lasts in average? This one is hard to say. Okay, it's really hard to say. But however, I look at a cycle with a complete 5 wave in about 3 to 6 months. Usually, a cycle of like a team or whatever is about 3 to 6 months, minimum 3 months. Sometimes it could be shorter lah. Okay, but then I'm looking at 3 waves. 3 months. So then you are counting the 1, 2, 3, 4, 5, AB 1, 2, 3, 4, 5 in 3 months. And then the ABC will be beyond 3 months. Okay. But however, it will be different on a case-by-case basis. It also depends on what is the chart itself and then what are their characteristics. So some chart like commodities, maybe they are faster. And then some chart like the forex, maybe you can see the trend better. So this one is a gray tag, and then you can also see the forex as well. Let's say the forex is EUR-USD. Okay, EUR-USD is a very trending forex pair. Okay, so you can see that EUR-USD is a very trending forex pair. Okay. So still on a horizontal move here. Okay, so it is still on a horizontal move and haven't have a breakout yet. Okay. But however, over here, this down, you can see roughly there are 3 waves down, roughly. Okay, roughly you can see 3 waves. But some you can combine now. Some are extended. Okay, is Elliott wave applicable for weekly chart? Yes. Yeah, true. So let's say we look at the KLCI or we look at, let's say we look at the KLCI, okay? And then we look at weekly chart. Okay, so you do see that weekly chart, it can show a better picture for the KLCI, in particularly KLCI, because KLCI, you need to see a big picture, then only you can make the sense out of it. Okay, so you can see that roughly about 3 waves here, and then here that you have some correction, and then you have this wave. So this wave is not very obvious, but rough guide lah. So this wave is actually clearer than just now the daily chart. The weekly chart here is actually clearer than the weekly chart that you see. Here you also see some wave here, some 3 waves down here, 1, 2, 3, some 3 waves down here. So hopefully we are about to have a breakout. Yeah, hopefully lah. Okay, don't know. can't promise anything, but hopefully we have a breakout. Okay, FCPO. Okay, FCPO. Okay. Okay, FCPO, let's see. Usually what I heard is that people who are in the FCPO, right, they are using the Elliott wave as well. Okay, so you see, I do all these lines is because I'm drawing the support and resistance line, and I'm also drawing the their bottom, major top and major bottom. So, but anyway, so these fine lines is when I wanted to, to see their support and resistance. So this one, maybe I need to go for a 1 hour or 4 hourly chart, then only I can see better. To move this thing. Cannot move. How about if I were to go for 4-hour chart? Let's see. I can move now. Okay. So for the FC pole, right? Actually, you can also see the wave here. It's like a rough count here. So here is a horizontal, and then here is the downtrend. So there's a possibility of going down further. Possibility, okay? I wouldn't say 100%, but there's a possibility of going down further by looking at the pattern like this. And it's a very long horizontal trend. Let's see. Let me minimize it. Okay. If you to see here, there is a clear 3 waves here. So here you can count very clearly. Okay, 1, 2, 3, 4, 5, very clear. Okay. Here is a correction. Okay, then this downtrend. Here you have a horizontal trend, then here you have a clear downtrend. And in this clear downtrend, you can also see some very clear waves as well. Okay, so these are all very clear waves. So meaning that whenever you can see a chart with some clear waves, so it means that the Elliott wave will work well in this chart. Okay, so this one is a FCPO. Okay, to apply the Elliott wave, if we can see clear wave counts, if not clear, avoid or try to use. Can I have your? So if let's say you have a clear wave, then you will use it. But if let's say you do not see a clear wave, then you do not want to use it, and then you can use other thing like chart pattern, candlestick, or indicator. You can use other thing. That other thing has to be a clear thing as well. Okay. So for example, you see that this particular trend, you see that the chart pattern is clearer because this one is a chart pattern there. So you see that this chart pattern is clearer. So perhaps over here, you trade the chart pattern instead of the Elliott wave because this one is a double top. And then here has a small top here. So you can draw a neckline here. And then now this one is fulfilling the price target of this height, the height between the neckline and the height here. And then now you are fulfilling the height of this height. So this is a chart pattern here. Yeah. So in the end, it will be like your foundation has to be strong. So you have to be clear in the chart pattern. You have to clear in Fibonacci in everywhere. And then when you look at the chart, you see which one is suitable. Okay, which one? If you see a clear chart pattern, you trade that clear chart pattern. You see a clear wave, you trade the wave. Do we need to consider the previous waves count as well before move to the current one? Previous wave as in, what do you mean by previous wave? Because when you are looking at, let's say you just look at this particular one, then you just look at this one. But of course, if you want to see the macro, you can always see the macro. Yes, you can. Okay. The macro is for you to see the big picture. And then after you see the big picture, then you zoom in into the smaller time frame to look at the opportunity. So the big picture will tell you a big bear or big bull, like a big macro outlook about that particular chart. Okay, whether it's a big bear or big bull. Then after that, then you can go in and see. Yes, you can. Okay. Okay, gold. Yeah, yes, gold is a flag. Yes. DXY. Okay, I'm afraid we do not have much time already. Yeah, now it's about 12 plus already. So, okay. Let me see if I have answered everybody's question. Weekly chart. Okay. Equity, how could I have suitable? Yeah. Cup and holder in money chart. Oh, that one cup and holder in money chart, is that talking about the goal or something? Sideways. Okay. Okay. Yeah, I think we have covered this, and then we will pass back to the host. Okay, Carmen, pass back to you.
Right. Yeah. So thank you, Pauline, for
Thank you.
your sharing.
Mm.
Right. Just for such a wonderful sharing. I do hope that everyone here did get something out of the session today. So let me just put up my slides. All right. So once again, thank you very much, Pauline. And I think, yep, we do hope that you have